Good morning and welcome to Stock Market Today for Tuesday, August 6th, 2019. I am your host, Dan Russo, Chief Market Strategist at Chaikin Analytics. Find me on Twitter at @Dan_Russo_CMT. Stock Market Today brought to you today and every day by Chaikin Analytics. Head over to chaikinanalytics.com/today, where you can sign up for a free email to follow along with this show, as well as get daily stock ideas for you to consider in your inbox every trading day before the market opens. So it was a wild one yesterday. Apologies for that. U.S. equities were sharply lower in Monday's trading. Most of the averages finishing 3% or close to 3% to the downside. All sectors closed lower on the day, but defensives outperformed. Technology and financials underperformed on the day. Treasury saw a rally across the curve. The dollar was weaker on the yen and the euro. Gold settled up 1.3%, and WTI crude was down 1.6% on the day. So futures were noticeably weaker after the close as well before staging a strong reversal. So for now, the SPY has broken through our key support zone, 2950 to 2900 to 2950 or 290 to 295 for the SPY, which could now turn to resistance. As we get to the desk this morning, futures are up 90 basis points to start the day. Asian markets were weaker overnight, with China down over 1.5%. European markets are moving higher. Treasuries are weaker following that big rally yesterday. The dollar is stronger versus the yen and the euro. Gold is down only 10 basis points. And WTI crude is up 0.5%. So here it is, S&P 500. Remember, we showed you those Fibonacci retracement levels yesterday. We cut below and then rallied back to close just about in line with the 61.8% retracement level. But support did break as those trade tensions escalated. We've been highlighting 2,900 to 2,950. We are now decisively through that zone. Start to think about 2,800 to 2,850 as support now. We're kind of in the zone. Resistance is in the area between 2,900 and 2,950. Old support becomes new resistance. On the plus side, in the near term, RSI did hit oversold levels, so potential for a snapback rally is there. But the fact that the market was able to become oversold bothers me. Bothers me a little bit. So basically the way that I'm framing it up right now is it's a little bit of a wait-and-see approach. I would expect volatility to continue. What I'm looking for is how the market reacts if and when we get back to 2,900. If we're able to retake the 2,900 level and remain above that level, I think it makes sense to start to get aggressive on the long side again, look for great opportunities, bullish and very bullish stocks in leading industry groups when those stocks become oversold. However, if we kind of rally back to 2,900 or don't even make it to 2,900, I think you have to start to think about raising cash, adjusting positions, maybe even looking for bearish opportunities in our bearish and very bearish stocks when those stocks are overbought with weak money flow. For now, speaking of money flow, it remains bullish, but obviously it has taken a sharp turn lower over the past 3 days. So really is a little bit of a wait-and-see approach for now. Want to look for a stabilization in the market. If you're bullish, you want to see a retake of 2,900. If you want to lean bearish, you're kind of shooting against that 2,900 level also. That's the line in the sand in the near term. If we remain below that, it probably makes sense to be conservative, defensive, or even aggressive to the bearish side, depending on your styles. Take a look at what we're talking about in our note today. Major averages closed lower by nearly 3%. We touched on that. Key support levels have been broken, and volatility is likely to continue here in the near term. A lot of back and forth on trade. And on top of that, we are still in the middle of earnings season. Defensive sectors have benefited from short-term rotation, and futures point to a possible turnaround Tuesday today. As we said, S&P futures up 90 basis points. Power bars, as you would expect on a day like yesterday, saw a massive deterioration. Dow loses 2.87%, 10 bears to 2 bulls. S&P 500 shifts strongly to the bearish side, 135 bears to 57 bulls as it lost nearly 3% on the day. NASDAQ took the hit, 3.5% to the downside, 33 bulls, 13 bears. Remember, only about a week and a half ago, this was close to 2.5 to 1. Bulls to bears, now we're bears to bulls. 33 bears, 13 bulls. Small caps also underperform. I'll call them an inline performer. 360 bulls, 385 bears. Small caps lose 3% on the day. Bonds, strong rally, up 1.75%, sending yields lower. According to the Chaikin Power Bar, large cap stocks are more bearish than small cap stocks. Major indexes are now all bearish from a power bar perspective. Stock of the day today, First Horizon National. It's a bank stock. Closed at 1552, down 2.33% yesterday, so a slight outperformer. Power gauge rating for First Horizon, ticker FHN, is very bullish due to very attractive financial metrics, very strong earnings performance, very strong price volume activity, positive expert activity. What I call this one here is possible personality change. What does that mean? Rating turns bullish, and then it begins to outperform. Now, you'll notice relative strength is neutral because it's newly outperforming. Some part of what we look for when we look at relative strength is persistency as well. Also neutral, the stock is not oversold, right? It's in the middle of the range. But we have bullish money flow above a rising long-term trend line, positive earnings surprise recently. This, to me, is a stock that you want to consider buying when the market stabilizes, especially if interest rates stabilize and the stock reaches an oversold position. But there is it's potentially a personality change, as I mentioned. So this is one that I'm going to be adding to my bullish watch list. We'll look for opportunities. I don't think you need to be a hero here, especially with the stock not quite oversold yet and interest rates under a lot of pressure, which should have a negative impact on banks. But take a look at First Horizon, because if rates do stabilize, there's probably opportunity here. Sector tracker now, movement of the major sectors over the last 5 days, as you would expect. All are negative, but the name of the game at the top of the list is defensive, REITs, UTEs, and healthcare. Materials, we've been warming to the group, starting to stabilize on a relative basis. Staples, another area where we've been warming, stabilizing, and beginning to move higher on a relative basis. Energy continues to be weak. Communication services on a relative basis is basing. Today's Tuesday, we do our relative strength work. Tech under the most pressure, as are discretionary names. The trade-sensitive areas of the market under a lot of pressure. And financials, as we said, being pressured by that drop in interest rates. Our industry in focus today, innovative technology services. Over the past 6 months, the group has underperformed by a little over 1%, and the power bar ratio, which measures future potential, is very weak. 30, count them, 30 bearish or very bearish stocks for only 7 bullish or very bullish stocks. Currently ranked number 17 of 21 subsectors and moved down 5 slots over the past week. So names within that group that you want to avoid, or even potentially look for bearish ideas: IQ, very bearish rating; Lending Tree, very bearish rating; and Zscaler, very bearish rating. And let's take a look at what we mean. We've showed you the checklist for setups on the bullish side. How about the checklist for names that you want to avoid? How about the checklist for names that are potentially bearish opportunities? The weight of the evidence approach applies in the opposite direction. Very bearish stock, weak trend, weak industry group, underperforming the market intensely, closer to overbought than to oversold, bearish money flow below a declining long-term trend line. Look at the checklist. 5 out of the 6 are red. At the very least, you know you don't want to own this name. And if you do trade to the bearish side, maybe you want to look for opportunities to open bearish positions, depending on your style. But just a great example of using the exact same process, just in reverse, to find the areas of the market and the stocks that you do not want to hold. Trending now, yesterday's S&P 500 gainers and losers. Tyson, earnings sent that stock up by 5%. And for those of you who read my market survival guide, you will know that Tyson is a name that we have been bullish on. And you got 800 basis points of outperformance yesterday. Abiomed sees a little bit of a rebound, up nearly 2%. JEC, earnings sent that stock higher by 1.7%. Lind, L-I-N, earnings good for a 1.5% pop. And Newmont, NEM, rallies with gold, up 1.4%. Speaking of gold, another area where we've been bullish in our market survival guide. On the loser side of the board, Nectar down 7%. Risk off, small and mid-cap biotech, not where you want to be in a risk-off environment. Win, China-related, down 7%. Valero, didn't see any real news, down 6.6%. NVIDIA, nothing company-specific. Chips were under pressure. NVIDIA does report on Thursday. And then we have Tapestry, TPR, down 6.4% on the day. Nothing company specific there. So just important to remember, with all the macro, right, trade dominating the headlines, we are still in earnings season, right? So you still have the potential volatility from trade as well as now earnings. ANSYS, ANSS, beat by 25 cents. International Flavors and Foods missed by 31 cents. That stock is trading lower in the pre-market. Lowe's beat by 7 cents. WEC, W-E-C, beat by 4 cents. And CLAC, K-L-A-C, beat by 7 cents. And the semiconductors, if you think the market's going to have a quick snapback rally, semiconductors are probably a good beta trade. CLAC's positive earnings might be worth a look. Before the open today, bullish names, AGN and FIS. After the close, AIZ is a bullish name that is going to report. Neutral names of interest before the open: Disca trading higher, Mosaic, MOS, as well as Regeneron. After the bell, all eyes will likely be on Disney, DIS. It does have a neutral rating at Chaikin Analytics. And then bearish names: EXPD and EMR before the open, FANG, Microchip, and WIN after the close. Microchip will be the one to really watch there for what they're saying and what they're seeing as it relates to their customers. They have a diverse customer base, pretty good read on the overall economy. Chaikin does suggest caution when holding bearish stocks ahead of earnings. So it is Tuesday. We do our relative strength work in our note to Chaikin Analytics clients. And rather than look at individual names, I thought we would look at a relative rotation graph. This is short-term in nature, and you can kind of see what's going on, right? The risk-on areas of the market and the ones that are levered to trade, tech and discretionary, falling into a weakening bucket. Comms stabilizing, does have defensive properties. Interesting to me that financials are in the leading category given what we're seeing in rates. But we've been talking about financials a little bit because the fundamentals from a Chaikin perspective, when we look at that power bar ratio, have been strong for quite some time. The real moves have been in the defensives and the bond proxies, right? Utilities and real estate move into improving positions. We've been talking about staples. Actually highlighted staples in my market survival guide a couple of weeks ago when we highlighted Tyson as a potential bullish idea. Materials, you heard me say I've been warming to that group. You can see they're moving into an improving state. Healthcare catching a bit of a defensive bid as well, and energy just continues to be, we cannot get anything going. Tried to move into an improving position, but quickly reversed course and is now lagging. Just continues to be an area of the market that we want to avoid from a trend perspective, as well as from a fundamental perspective. Also, industrials taking a sharp turn here, still in an improving group, but starting to point in the wrong direction. So as you can just get a sense for the short-term rotation in the market very quickly by looking at a relative rotation graph like this. And as it relates to tech, we're wondering, is that a false breakout on a relative basis? XLK relative to SPY breaks out and then promptly reverses course and back into the consolidation. Now, I think what we're going to see is a consolidation before a continuation higher. Why? Number one, RSI did not become oversold. We're still technically, well, pretty close to bullish ranges as an RSI for this ratio. Still in an uptrend, still above the rising 200-day moving average, and on an absolute basis, still an uptrend, right? Testing support right now. So if tech is able to hold on an absolute basis, I would look for it to begin to start to outperform after a bit of consolidation. But the weight of the evidence right now doesn't point to a big reversal. Obviously, that can change on a dime, but from a technical perspective, tech looks to still be okay on a relative basis. A break of this trend line would bother us, open the door to the 200-day moving average, especially if it coincides with oversold readings for the RSI. Finally, we've been talking about consumer staples, and we're wondering, are consumer staples emerging leadership? Slightly different chart here this time. We're looking at the XLP on an absolute basis, and you can see we fell below the 50-day moving average yesterday, but found support and rallied. We are above a rising 200-day moving average. RSI has not become oversold. So if we can get a rebound here and retake the 50-day moving average without becoming oversold, to me, that speaks to a continuation of the positive trend for consumer staples. And at the same time, we are seeing a break of the recent downtrend on a relative basis. The line at the bottom here is that ratio chart, XLP relative to SPY, and you can see we're moving up and out. Consumer staples are a defensive area of the market. So to the extent that the S&P 500 fails to retake 2,900 and begins to turn lower again, for those of you who look to stay invested and skirt to the areas that are outperforming the market, you're going to want to pay attention to consumer staples and the other defensive areas of the market. If your view is that we're lower from here, you want to look for opportunities within the staples if you're running a balanced portfolio. I'm never one to make the call to go to cash. I prefer to rotate portfolios to the names that are outperforming in the areas that are outperforming because I think the call to could be all in or all out is a difficult one to make from an emotional standpoint. So want to start paying attention to the staples, and I'll just tell you, head over to chaikinanalytics.com/survival-guide to get your weekly action plan for surviving and thriving in any market. I will be back here tomorrow.